McGraw-Hill Ascent Audio presents The Complete Guide to ETF Portfolio Management, The Essential Toolkit for Practitioners, by Scott M. Weiner. Narrated by Christopher Grove. This work is provided as is. McGraw-Hill Education and its licensors make no guarantees or warranties as to the accuracy, adequacy, or completeness of, or results to be obtained from using the work, including any information that can be accessed through the work via hyperlink or otherwise, and expressly disclaim any warranty, express or implied, including but not limited to implied warranties of merchantability or fitness for a particular purpose. McGraw-Hill Education and its licensors do not warrant or guarantee that the functions contained in the work will meet your requirements, or that its operation will be uninterrupted or error-free. Neither McGraw-Hill Education nor its licensors shall be liable to you or anyone else for any inaccuracy, error, or omission, regardless of cause, in the work, or for any damages resulting therefrom. McGraw-Hill Education has no responsibility for the content of any information accessed through the work. Under no circumstances shall McGraw-Hill Education and or its licensors be liable for any indirect, incidental, special, punitive, consequential, or similar damages that result from the use of or inability to use the work, even if any of them has been advised of the possibility of such damages. This limitation of liability shall apply to any claim or cause whatsoever, whether such claim or cause arises in contract, tort, or otherwise. Introduction. In the 20th century, the dominant investment vehicle in the United States was the mutual fund, a pooled instrument from a number of investors that is professionally managed by a mutual fund company. Toward the end of the century, in 1993, however, the Securities and Exchange Commission approved an application for listing a mutual fund-like product that differed from the traditional mutual fund in several ways. In particular, and most significantly, while mutual funds did not trade on exchanges like stocks, these new products would, with funds changing hands at a market-determined price as opposed to the net asset value, NAV, of the fund. The NAV is the per-share value of the fund at the close of the business day. With this innovation, the exchange-traded fund, or ETF, was born. Just over 25 years later, the ETF industry has grown substantially more than anyone in 1993 could have imagined, with over $5.5 trillion invested in more than 2,000 products in the United States alone. The products cover virtually every sector of the financial landscape, from equities to fixed income, currencies to commodities, domestic to international. An investor seeking to find a product that provides exposure to some corner of the market is at least as likely to find that exposure in an ETF as he or she would in a mutual fund. In 2014, and almost every year since, flows into ETFs outpaced flows into mutual funds. It is fair to say that not even a quarter of the way into the 21st century, the ETF has overtaken the mutual fund as the dominant financial instrument of the times. For investment companies themselves, the advent of the ETF has had a profound impact on portfolio management. Portfolio management used to be about what you held in the portfolio at any given time. Index tracking products simply sought to hold the underlying positions of the index, and actively managed products sought to hold positions chosen by the portfolio manager, PM, without any mandate to necessarily track an index. In the ETF era, however, a mutual fund and an ETF that track the same index are managed by their respective portfolio managers in entirely different ways. Even actively managed portfolios in ETF structures are managed differently than actively managed mutual fund portfolios. It's no longer appropriate to simply teach or learn portfolio management full stop. We need to distinguish the practice dependent on the product. This book is believed to be the first of its kind, dedicating its content entirely to the complete practice of managing ETF portfolios. It is intended for aspiring PMs and seasoned practitioners alike, and with the explosive growth in assets in the sector, ETF investors can also use this book to look under the hood of the products they own to see exactly how they run. Every ETF investor should know how the product operates. All the basics of ETFs and the ETF portfolio management process are covered, and the book includes advanced topics in a wide array of areas as well. In Part 1, we concentrate on the ETF industry in the United States. This part reviews the regulatory framework that gave rise to the proliferation of ETFs, surveys the variety of ETF structures available in the marketplace, presents a snapshot of the marketplace as it looks today, and details the ETF ecosystem and the types of organizations that make the industry function day to day. With this overview in place, we move on to Part 2, where we delve into passive or index-based ETF portfolio management. We discuss the entire index process, covering how indices are defined and how PMs remained informed about all the intricacies captured within an index. We construct a hypothetical index to serve as the basis for an ETF to be managed throughout the book, and we lay the groundwork for what will happen when the index rebalances and how the rebalance will impact the ETF PM. The focus on index-based ETF portfolio management is intentional. As we will discuss later, we believe that a lot of the tools employed by index-based ETF portfolio managers can also be employed by active ETF portfolio managers. Then in Part 3, we effectively launch a hypothetical ETF, as if we worked at an ETF sponsor. We discuss methods for seeding the fund at inception and describe the critical role the primary market plays in ETF portfolio management. In Part 4, we present the 3 T's of ETF portfolio management: tracking error, transaction costs and taxes, and the 3 C's of ETF portfolio management: cash, corporate actions, and custom in-kind baskets, CIBs. We discuss the trade-offs required as the PM seeks to minimize each of the T's, and we consider how the 3 C's impact the PM's ability to do so. We keep a focus on equity-based ETFs as some of the key aspects of portfolio management that enable the efficiency of ETFs can be easily demonstrated by this asset class. The last chapter in this part addresses the process of portfolio rebalancing, which differs from the index rebalancing discussed in Part 2. In Part 5, we expand the product set. We discuss how international ETFs present new challenges to the ETF PM, particularly around non-contemporaneous market timing. Our discussion pertains to ETFs domiciled in the United States. Next, we turn to a growing segment of the ETF landscape, actively managed ETFs, that is, those that are not formally tracking an underlying index. Despite the absence of an index to be tracked, some of the methods employed in passive ETF portfolio management are surprisingly relevant in the actively managed ETF space, as mentioned. We continue the focus on expanding the product set by exploring fixed income ETFs, another growing segment of the ETF industry. We end Part 5 by investigating leveraged and inverse products, those that seek daily returns equivalent to multiples of an index's return on a particular day. These products require different portfolio management strategies from those used for non-leveraged products. There are, of course, other asset classes or products that are not covered here, such as commodities, currencies, and derivatives-based strategies. We also primarily focus on open-end investment companies. Finally, in Part 6, we consider situations where particular challenges make managing an ETF difficult. We begin with a chapter on market turbulence, as extreme volatility can wreak havoc on the ill-prepared ETF PM. Next, we discuss how representative sampling can be a preferred technique for indices that are hard to track in the passive space. If all else fails, it is possible for the fund sponsor to shut down an ETF, and we address the implications of this for the ETF PM in the final chapter. The overarching goals are to prepare aspiring PMs to handle the basics as well as some of the more nuanced situations that arise in ETF portfolio management, and to give seasoned veterans insight into situations that either they haven't yet come across or they have come across and were left puzzled about how to handle. The days of PMs just having views on stocks, bonds, or asset allocation are over. The modern-day PM needs to manage not only the content of the portfolio, but also the structure of the product. For the exploding ETF marketplace, this book will prepare you for that tall task. Let's get started. Part 1. The ETF Industry. Ask a professional athlete how to play his or her sport, and you're likely to get a description of the playing field, and maybe even a bit of history before you get to the nuts and bolts of skill and strategy. In that vein, we begin our journey into exchange-traded funds, ETF Portfolio Management, by describing the environment in which the practice takes place before reviewing the act of portfolio management itself. The incredible rise of the ETF industry has its roots in the regulatory environment of the early 1990s. In Chapter 1, we provide an overview of that environment, along with the growth narrative of the product in the ensuing decades. In Chapter 2, we provide an overview of the ETF ecosystem, with a clear focus on how the ETF Portfolio Manager fits within the framework. Chapter 1. Birth of an ETF. Industries evolve through disruption and innovation. In some industries, it is hard to pinpoint when that disruption occurs. In others, there is a watershed moment that permanently changes the landscape. In some cases, that moment may not even be known at the time, but only through the lens of history does it become clear. Startups are laser-focused on disruption and innovation, desperate to be the company that upends the status quo. Business schools teach disruption and innovation, hoping to instill vision in future leaders to find those areas of an industry ripe for attack. Examples of disrupted industries where innovation changed the nature of the industry are virtually everywhere, from digital cameras displacing film-based products to liquid soap pushing out bar soap to take top spot in the personal hygiene market. Putting aside the innovations that drove these new industries, what is striking about disruption and innovation is how disruption-proof the industries appear at the time they get disrupted. Take the mobile phone market, which of course disrupted the communications industry. In 2007, the cell phone hardware market was dominated by Nokia brick phones, a 53% market share, and mobile operating systems were also dominated by Nokia through its Symbian operating system, a 67% share. Nokia was the cell phone Goliath. The company had over 1 billion customers in 2007. Forbes magazine had dubbed Nokia the cell phone king. The company and its industry appeared virtually untouchable. But that year, Apple recognized the value in integrating a software platform, think apps, with the hardware to access it, think iPhone, and a new paradigm in cell phones emerged, one that led to competition between the Android platform and iPhone's iOS platform. Cell phones were no longer phones. They were pocket computers with operating systems that moved the industry forward. Nokia failed to adapt, and now instead of a Nokia brick phone in your pocket, you likely have an iPhone, or perhaps a Samsung, running on an iOS or Android operating system. In 12 years, the market share of Symbian went to 0, and the market shares for Android and iOS went respectively to 76% and 22%. A seminal moment for disruption in the investment management industry came in 1993. To set the stage, at that time the investment landscape looked like the cell phone landscape. The dominant product was the mutual fund, a product in which multiple investors pooled funds that invested in securities to their mutual benefit, or demise. Regulations were firmly established that outlined how the products worked and the rules that investment companies were required to adhere to when running a mutual fund. About $6 trillion was invested in mutual funds in 1993. The mutual fund industry appeared disruption-proof. So how do you disrupt a multi-trillion-dollar industry, one that is well regulated, with a defined set of rules entrenched in the financial markets, transparent for every market participant to not only see but adhere to? Simple, actually. You change the rules. Working with State Street Global Advisors, the American Stock Exchange, Amex, through its wholly owned subsidiary PDR Services, asked the Securities and Exchange Commission, SEC, to relax some of the requirements outlined in the regulations surrounding mutual funds. In doing so, Amex took the first steps toward upending the mutual fund market, becoming the Apple in the asset management industry before Apple upended the cell phone industry. Specifically, the request was for the SEC to allow Amex to list a fund, Standard & Poor's Depository Receipts, SPDR, S&P 500 ETF Trust, under the ticker SPY. SPY is a unit investment trust. Claims to securities are traded, not the securities themselves, that would trade on the exchange just like a stock and relieve Amex of several other restrictions imposed on mutual funds. With the SEC's approval, mutual fund disruption was underway. And while mutual funds still maintain a dominant position in the financial landscape, the ripple effect of that first product launch in 1993 is far-reaching. Mutual Fund Regulatory Acts and Exemptive Relief. A deeper dive into the regulatory environment and how exactly SPY changed the industry is worthwhile, especially because the regulatory environment continues to evolve to this day with the adoption of the SEC's new ETF rule. 4 specific regulatory acts formed the foundation of the modern-day mutual fund industry: the Securities Act of 1933, the Securities and Exchange Act of 1934, the Investment Company Act of 1940, and the Investment Advisors Act of 1940. We won't spend much time on them. There are many places where the interested listener can find details about or even read these acts. For our purposes, though, what is interesting is that within this labyrinth of rules, the folks behind the SPDR effort managed to find a few rules that they would ask the SEC to relax for them. In doing so, the ETF revolution was started. The focus was on the Investment Company Act of 1940, commonly referred to as the 40 Act. The 40 Act effectively governs mutual funds, establishing what it means to be an investment company, and was designed on the back of the Acts of 1933 and 1934 to protect investors in the wake of the financial collapse that began in 1929. The SPDR application to the SEC asked for exemptive relief, in other words, permission from the SEC to violate some of the rules set out in the 40 Act. A standard exemptive relief application seeks relief from 3 key parts of the 40 Act, allowing the fund to 1. Issue shares that are redeemable at the NAV, net asset value, in creation units only, 2. Receive securities from and transfer securities to authorized participants, in-kind transactions, and 3. List those shares on an exchange to be traded according to market dynamics as opposed to NAV. That might sound technical, so let's break it down. Redemption in creation units puts a barrier between the investor and the fund sponsor. No longer could investors give a few shares back to the fund sponsor. Rather, they had to accumulate enough shares, a creation unit, to redeem those shares, which was often 50,000 shares or more. Disintermediating those transactions would be the authorized participants, APs, market makers that would stand between the end investor and the funds, facilitating these transfers of creation units. No longer would the end investor transfer shares to the issuer. APs could transfer securities in exchange for shares of the ETF in a creation and submit shares of the ETF in exchange for a set of securities in the case of a redemption. These in-kind transactions would have significant implications, which we will discuss in depth. Finally, when mutual fund shareholders bought shares from or sold shares back to the issuer, they did so at NAV. The exemptive relief application asked the SEC to allow the shares to be traded on the market much like a stock would trade on an exchange. There are often other relief requests that come with applications, such as lifting restrictions on position limits in investing in other funds, and allowing for delays in processing redemption proceeds. Funds also request relief from certain provisions of the Securities Act of 1934 that chiefly deal with the distribution of ETF shares. Why has the granting of these relief requests been so instrumental in building a brand new marketplace that has fundamentally changed the landscape of the investment universe? For one, investors seek liquidity, the ability to get in and out of securities at a transparent price at any specific time. The exchange trading provision allowed funds that previously only traded at NAV at the end of the day, which of course would be unknown during the day, to be exchanged at any point in the day, just like an individual security. If an investor seeks to get out of a mutual fund position at 9:31 a.m., he or she must wait until the NAV is struck at the end of the day to know the price received for the shares. Second, as we are going to see a lot in this book, ETFs created tax efficiencies relative to mutual funds that would have profound consequences for investors. In a nutshell, when shares of a mutual fund are redeemed and securities are sold by the mutual fund company to provide cash to the redeeming investor, if those shares are sold at a capital gain, that gain is distributed to all the mutual fund holders at year-end. Even if you have not sold any shares of the mutual fund, if someone else has, you could be, and often are, liable for the tax consequences of security transactions in the fund. Some of these structural features of ETFs, namely the authorized participant feature, and how transactions with APs were structured, in conjunction with the tax treatment for AP transactions, allowed for the isolation of one investor's activities from those of all the other investors. These provisions also allow for more efficient tax management of ETFs. Finally, the open-ended structure of the ETFs and the creation and redemption mechanism with authorized participants created an arbitrage mechanism that aimed to keep secondary market prices in line with the NAVs of the products. This ensured that investors buying and selling in the secondary markets would receive a fair price, that is, a price closely reflecting the value of what was held in the portfolio. No one class of investors, for example institutions, would have any material advantage over any other class of investors, for example retail investors. There are other reasons, of course, that have contributed to the growth of the ETF industry, including a lower fee model, a rise in indexing more broadly, and the growth of the registered investment advisory sector, relying heavily on the products, as well as some novel investment concepts that have been packaged in ETF form. Taken with the tax efficiency and liquidity of the offering, it is no wonder the product has steadily taken market share since its debut. The ETF industry today. What started out back in 1993 as a relatively small ETF trust, the Spider S&P 500 ETF trust had about $6 million at inception, has grown into a substantial and important piece of the financial industry landscape. This growth provides the core context for why this book is necessary. As of December 31, 2020, the Spider S&P 500 ETF Trust had $332 billion in assets under management, AUM, an all-time high. In the last 25 years, since the advent of the ETF market has grown to over $5.5 trillion in assets. In terms of assets, ETF assets have grown to over 20% of mutual fund assets. That doesn't sound like much, but looking at this headline number doesn't scratch the surface when exploring the ETF growth story. To understand why, consider the dominant position that mutual funds hold in the retirement industry. According to the Wall Street Journal, which cites the investment company Institute, ICI, 80% of the 56 million households who own mutual funds buy them through employer-sponsored retirement plans, and the ICI estimates that 54% of mutual fund assets are held in retirement accounts, a sum of over $9.4 trillion in 2019, and $9.9 trillion if money market funds are included. Most of these retirement accounts don't even offer ETFs, primarily because 1. There would be considerable technological enhancements required on their platforms to accommodate intraday trading. 2. Fees to plan administrators could be lower with ETFs. And 3. Tax efficiency is not relevant in this sector of the investment industry. As a result, there is a large barrier to entry for exchange-traded funds. Measured against the non-retirement assets, though, ETF assets have grown to roughly half the assets of the mutual fund industry when the playing field is leveled. When ETFs reach their inevitable tipping point in employer-sponsored plans, the rise of ETFs relative to mutual funds will be swift. From a flows perspective, by at least one metric, trailing 12-month net new flows, ETF flows have exceeded net new flows into mutual funds from 2014 through 2019. In the midst of the COVID-19 pandemic, a strong reversal took place, primarily due to over $1 trillion of flows into taxable money market mutual funds in March and April 2020. If this trend continues, and there is little reason to believe it will not, the ETF industry will ultimately surpass the mutual fund industry, especially if ETF-based defined contribution platforms gain a foothold in the retirement industry. According to some industry watchers, global ETF assets are expected to exceed $10 trillion by 2023, and some estimates put ETF assets ahead of mutual fund assets by as early as 2024. New product launches clearly favor ETFs as well. Since the year 2000, cumulative net new ETF launches have exceeded 2,000 products, while cumulative net new mutual fund launches have actually been negative. ETFs cover virtually every corner of the market. Pure beta products track the major indices like the S&P 500. So-called smart beta products seek to provide beta to the market through newly created indices with alternative weighting schemes, often factor-based, aiming at outperforming a benchmark. Multi-asset ETFs provide exposure to a set of markets such as equities, fixed income, currencies, and commodities, seeking to mimic the overall allocation of an investor's portfolio in one structure. There are ETFs that provide leveraged exposure to underlyings, inverse exposure to underlyings. When the underlying goes up, the ETF goes down and vice versa, and nonlinear payouts constructed with options or underlyings of interest. There is no shortage of categories. The new categories seem to emerge on a frequent basis. Many of the new product launches come from companies trying to compete with the dominant players in the market, the ETF Big Three, BlackRock, Vanguard, and State Street, whose assets dominate the ETF landscape. When one of the Big Three offers a product, it is virtually guaranteed to succeed, or at least maintain a profitable level of assets due to its scale, infrastructure, and relationships to support and market the products. Many broker-dealers act as gatekeepers by requiring minimum asset levels and performance to be included on their platforms for use by financial advisors, and the larger firms have an easier time meeting those requirements. In contrast, one consequence.
Sample complete. Ready to continue?